Hi, welcome back. In the last session, we started our discussion of growth investing by looking at small cap stocks. In this one, I'm going to focus on another strand of growth investing where you focus on companies that are just going public. Private businesses going public, the initial public offering story. The question we're going to try to answer is there an opportunity here for investors at the time a company goes public for them to make money? Now, the process by which private business go public follows a fairly established structure. The private business approaches an investment bank, usually because you need the investment banking advice and support along the way. And we'll talk about what's changing about that process. That investment bank puts together a syndicate of other banks. That bank then provides an investment banking guarantee, a price guarantee. And don't get too excited. It's not as ironclad as it looks in return for an underwriting fee. What's the underwriting fee? A percentage of the proceeds from the IPO offering go to the investment banker. And to make an investment in an initial public offering in the US, a company has to file a prospectus. A prospectus has all of the financial statements you get in a traditional public company. And at least in theory, everything should be restated using accounting standards that govern public companies. So if you look at the process, here's how it begins. A company approaches an investment bank. The investment bank decides to go ahead and be the lead investment banker. The lead investment banker puts together a syndicate. And the size of the syndicate will depend on the size of the offering. A prospectus gets filed and an investment banker can help the company put the prospectus. The prospectus doesn't just give the historical data of the company, it lays out what the company hopes to do with the offering proceeds. The lead investment banker values, and I put it in quotes because they really price the company. And that price is not the final price. They test the price out, they do a sales pitch, and eventually they set an offering price that's guaranteed. And then the offering happens. At the offering price, clients of the investment bank try to get shares at that offering price. And on the offering day, the company is open for trading. That process is coming under stress now because there are alternative ways. In fact, there are some companies which directly list the market. They bypass the offering process and an offering price. They go to the market and demand and supply. An auction process sets a price. There's also a variant where you set up a special purpose entity, a SPAC. The SPAC actually just collects the cash. You invest in the SPAC. It's a publicly traded SPAC with assets just being the cash they hold. That SPAC then merges with a private business, and that is the process in which it goes public. That private business is now a public company. Direct listings and SPACs are still the exception. The rule is still this process. And the question is there anything about this process where there are frictions you can exploit as an investor? Well, on the offering day, remember the investment bank set an offering price and they guarantee the offering price. One reason they're able to guarantee the offering price and not face too much risk is they systematically underprice offerings. This is no secret. It's in the investment banking guidebook for pricing IPOs. Is you price the IPO and you knock off 10 or 15% off the price, you underprice the IPO. We'll talk about why the issuing company might be okay with this because this seems like you're leaving money on the table. But that is the offering price. The company opens for trading on the offering day. Given that the offering price is set too low, no surprise, there's a jump in the price. And you can see that jump in the price in the first day can be a pretty significant number. In this graph, I look at the jump in prices. And this is a study that goes from 1983 to 2018. The jump in the price, and in each period, that's less. There are a few companies where the stock price actually drops, but they're relatively few. Most companies, the price jumps by 10%, 15%, sometimes by 50, 80, 100%. There's underpricing systematically, and on the first trading day, the price jumps. Now, as an investor, you're saying, I can make money on it. Hold on for a moment. We'll talk about why it might be difficult to make money, but on that first day, clearly there's a jump in the price. Now, if you track through and take a deeper look at the IPO pricing, on average, IPOs are underpriced by about 15 to 20%. The 15.8% is false precision, but about 15 to 20%. And in many cases, the offering price is in fact revised upwards before the offering is made because, as I said, the initial price is just a trial price. You test it out against investors. If they seem enthusiastic, you might push up the price. And if you base IPOs based on whether the offering price was revised down or revised up before the offering, you find that the IPOs where the offering price was revised up see a much bigger jump in the stock price in the opening day than the IPOs where it was revised down. Again, file it away if you're an investor saying maybe I can use that to make money. And if you look at the IPO underpricing over time, IPOs have always been underpriced, but they ebb and flow. In this graph, I look at the underpricing by looking at the return on the first day. Now, when I say return on the first day to an IPO, we'll talk a little bit about when that return happens, but you can look in every single year, at least on average, IPOs go up. But in some years, the jump in the price is very small. It's 3%, 5%. Some years, it's 50%, 80%. And to give you a clue as to when these big jumps happen, take a look at the late 90s or the first part of this decade, 2020, 2021. You could see a big jump. Those coincided with boom markets, the dot-com boom, the boom coming out of COVID. So clearly there is a correlation here between how well the market is doing and what happens on that offering day. But there's been underpricing over time. And that underpricing is not restricted just to the US. You see it in almost every European country. This is from a fairly dated study, but in every single country you see on that first day of trading the jump in the price. Now let's talk about why, as an investor, this is not an easy way for you to make money. Let me play through a very simplistic strategy. IPOs on average jump on the first day of trading, right? What if you subscribe to 100 shares in every single IPO, or 1,000 shares, or 1,000,000 shares in every single IPO that's coming, right? And you got those shares at the offering price. You should see a pretty significant return because on that first day the price jumps. You're saying, why can't I do that? Well, 3 reasons. One is selection bias. Let's play this through. If you seek out 1,000 shares in every single IPO that's coming out, remember you're doing this before the offering day. In some of those IPOs, you're going to get the 1,000 shares you asked for. In some you might get 800, some you might get 600, some you might get 200. You think, so what? Think of the kinds of companies, IPOs, where you're going to get all of the shares you asked for. They're going to be the overpriced IPOs, right? That 10 or 15% of IPOs where the price goes down, because there the demand for the IPO is not as heavy. The IPOs where you will get 200 shares when you ask for 1,000 will be the most underpriced IPOs. So when you look at your overall portfolio, it's going to be overweighted with IPOs that are overpriced and underweighted with the IPOs that are most underpriced. So that's the first problem, is the selection bias. The second is, and we'll take a deeper look at this, is IPO markets go through hot and cold phases. What does that mean? There are years where you can get hundreds of IPOs and years where you get almost none. And if your entire strategy is built around IPOs, what do you do during the famine years? There's nothing to invest in. And third, as we will see, timing is everything. Even if you got lucky, you were able to get IPO shares at the offering price and you got that first day jump, if you don't sell at the right time, you might not be able to harvest the gains that you thought you were going to have. So let's dig a little deeper into each of these problems. Let's start with the selection bias. Part of it I've already put on the table, which is if you apply for every IPO, if your IPO is overpriced, you'll get all of the shares you asked for. If your IPO is underpriced, you'll get only a fraction of your request, right? And the more underpriced, the smaller the fraction will be. If on top of that investment banks play favorites, and let me explain what I mean by play favorites. Investment banks have preferred clients, they're big clients, and they might take their best IPOs, their most underpriced IPOs, and give preferred clients a larger share of those shares. In which case, if you're an outsider, you're going to get even fewer shares. It makes the selection bias worse. Put simply, if you just try to invest in every single IPO that's coming out, you're going to be overweighted, your portfolio. is going to be overweighted in overpriced IPOs and underweighted in underpriced IPOs. In fact, there are mutual funds and people who've tried to replicate the IPO underpricing in their portfolios, and it doesn't seem to pay off. That's a selection bias. The IPO cycle, as I noted, the number of IPOs change on a year-to-year basis, and the amount that they try to raise also varies. If you take a year like 2021, huge year for IPOs in terms of the amount of money raised and the number of IPOs. Again, late 90s, huge years for IPOs. As I mentioned earlier, that might have something to do with how well the market is doing. But if your entire investment philosophy is built around IPOs, what do you do in the lean years? How do you get through them? So that's the second problem. And here's the third one. Let's say you get lucky, and as I said, you get the IPO, you get the money on that first day, 10%, 15% jump. That's pretty good, right? Well, if you continue to hold that stock, and sometimes you might have no choice, investment banks might require you to hold the stock, because if you don't, you're not going to get your next IPO request. The longer you hold the shares, the more you suffer. In this study, for instance, the study looked at the returns to IPOs after the IPO in year 1, year 2, year 3, year 4, year 5, in every single year. The IPO portfolio actually underperformed the non-issuer portfolio. So if you made money on the opening day and you held for 5 years, by the end of the 5th year, you might end up losing money to somebody who never got in the IPO and bought non-issuing companies, traditional public companies instead. Now, as an aside, you might say, why do the issuing companies go along with this? Why do they let investment bankers underprice their offerings? It's worth remembering that on the offering day, only a portion of the shares are offered to the public, 8%, 10%. And that portion has dropped off over time. 40 years ago in an IPO, you might have raised 40% of your shares might have been offered to the public. Today, it's 8, 6, 5%. And when you're offering that smaller percentage, you might be okay with the underpricing because you view it as like a loss leader in retailing, as something that will draw on investors to try to come in to buy your stock, because you as the founder or the VC might not be able to get rid of your shares for 6 months or a year, and you want good PR, good news stories about you, and this might provide it. Now, if you look at that study, what happens post-IPO, and you look across time, you see the phenomenon kick up over time, which is every single time period here. If you look at the day 1 return, you get the big upside, but you look at the 3-year return, not so great. An IPO strategy, almost by definition, might be a short-term investing strategy. You get the IPO, luckily at the offering price, you hold through the first day, and you better get rid of those shares pretty quickly, 3 months, 6 months. And the question is whether you'll be able to get away with that strategy if you're an investor who invests only in IPOs. Will the investment banks even accept your subscriptions if they know you're the kind of person who flips the shares around? Now, one of the things that you want to keep in mind, in addition to the fact that the IPO process itself is getting disrupted by direct listings and SPACs, is the type of companies going public has changed, especially in the US. If you look at the typical company going public in the 1980s, an Apple or a Microsoft, these were companies with well-formed business models, relatively small revenues, but making money. Over time, 2 things have happened. One is companies are waiting longer to go public in terms of size. They're scaling up more. The median sales of a company going public has risen over time. Why are they able to get away with it? Because now you're able to raise capital, not just from venture capital, but from public equity investors who've entered the private company space. Uber was able to raise money from Fidelity and T. Rowe Price well before it went public. So the typical company going public is bigger. And here's the catch. It's bigger, but it has a less formed business model. It's more likely to be money losing. You're getting bigger money losing companies going public, especially in the tech and the biotech space. And as an investor, investing in these companies as they go public, you have to recognize that that brings with it its own set of risks. Bigger companies, unformed business models, you're running the risk that these business models might never get formed. So let's say if after all of this, you decide that you want to make money on IPOs, and that's going to be the basis, at least of a portion of your investment philosophy. It might not be a core philosophy. Here's the key. to being a successful IPO investor. First, you got to find the right IPOs. Not all IPOs are equal. As you saw, some IPOs jump a lot on the offering day and do well in the subsequent period. Some jump on the offering day but do badly in the subsequent period, and some actually drop on the offering day. You need to do your research, not take it for granted that every IPO is going to give you that 15% jump on the offering day and deliver returns thereafter. And that requires bringing in the tools of valuation, tools of investing, understanding the business of the IPO before you jump in. Second, you got to learn to play the allotment game better. Because remember, if you just send out a request for 1,000 shares in every IPO, you get that selection bias working against you. If you can tilt the game in your favor by becoming a preferred client or working a way to get a larger percentage of the shares in the underpriced offerings, it'll improve your odds. And third, you got to figure out how long you can hold an IPO before you sell it. Remember, we talked about momentum trading and in the context of trading. That might need to come into play. You might want to invest in IPOs and be a momentum trader, know when to get out as the momentum is shifting. And if you can do all of that, it is conceivable that adding an IPO component to your philosophy, so that might be a sub-philosophy, might actually augment your returns. I hope you found this session useful, and I thank you very much for listening.